Welcome to StockTok's deep dive into Adobe Inc. Adobe is a global software company that powers creative professionals and enterprises through its suite of design, marketing, document management, and digital experience tools. As of May 1st, the stock is trading at $250.71 per share. Over the past 52 weeks, the stock has ranged from a high of $422.95 down to a low of $224.13. The current price sits near the 50-day moving average at $250.52, but below the 200-day average at $314.24, suggesting the stock has pulled back from its highs. The Relative Strength Index, or RSI, stands at 53.5, indicating neutral momentum. Let's work through the fundamentals scene by scene, starting with a quick business overview. Adobe generates revenue through subscription-based software delivered via the cloud. The company's Creative Cloud division serves designers, photographers, and video professionals through tools like Photoshop and Premiere. Its Document Cloud handles digital forms and e-signatures. The marketing and analytics business serves enterprise clients. The company benefits from high customer switching costs and a dominant position in creative workflows that competitors struggle to displace. The StokTok Score is 78 out of 100. Breaking down the 5 dimensions: valuation scores 17 out of 20, financial health 19 out of 20, profitability scores a perfect 20 out of 20, growth comes in at 14 out of 20, and smart money positioning scores 8 out of 20. Now, valuation. The question every investor has to answer: are you paying the right price? Adobe trades at 14.6 times trailing 12 months earnings, which sits well below historical technology sector averages that often command multiples in the 20s or 30s. The forward price-to-earnings multiple is even more attractive at 10.65 times, suggesting the market expects earnings growth ahead. The price-to-earnings to growth ratio, or PEG, comes in at 0.77, which is considerably below 1, a signal that the company's valuation appears reasonable relative to its growth trajectory. The enterprise value to EBITDA multiple stands at 9.92 times, also lean by technology standards. The price-to-sales ratio is 4.31 times, a reasonable metric given the company's high-margin software business model. In our view, Adobe's competitive moat stems from the entrenched nature of its creative tools, substantial switching costs for millions of professionals, and the network effects that emerge when design teams collaborate within the same ecosystem. These factors support pricing power and recurring revenue stability. Our discounted cash flow analysis suggests the stock is trading at a discount to intrinsic value, with a margin of safety of 63.42%. Wall Street analysts have a consensus mean price target of $328 based on 34 total analyst coverage. The analyst range is wide, a high target of $487 and a low of $220, reflecting some debate about the company's trajectory. Most recently, Adobe reported second quarter results for 2025. The company beat earnings expectations, delivering $5.06 per share against a consensus estimate of $4.97. However, revenue came in at $6.4 billion, which the market initially appeared to digest without major volatility. Year-over-year revenue growth reached 3.30%. Operating income was $2.42 billion, and net income totaled $1.89 billion. The modest after-hours reaction suggests the market had largely priced in these results. Market sentiment around Adobe leans moderately bullish, driven by a significant $25 billion share repurchase announcement and strong product demand signals across Creative Cloud. However, broader technology sentiment and chatter around alternative technologies temper some of the enthusiasm. In our view, the valuation setup looks attractive given the earnings multiple, the DCF margin of safety, and Wall Street's mean target implying upside from current levels. Moving to financial strength, how solid is the foundation? Adobe scores 8.0 on the Piotroski F-score, a 9-point checklist that evaluates profitability, operating efficiency, and balance sheet quality. A score of 8 indicates strong financial health on nearly every dimension of that test. The Altman Z score sits at 7.30, well into the safe zone, that suggests virtually no bankruptcy risk. This model, developed to assess distress, clearly shows Adobe has a fortress balance sheet. On the debt side, the company maintains a cash-to-debt ratio of 1.04, meaning the company holds more cash than total debt, a position of strength. Interest coverage is exceptionally high at 33.94 times, meaning operating earnings dwarf annual interest obligations by more than 30 times. There is no meaningful debt service stress here. The current ratio stands at 0.91, which is slightly below the conventional 1-to-1 benchmark. But this is typical for large, profitable software companies with strong cash generation that don't need to maintain excess working capital. Debt to equity is 0.58, a moderate leverage profile that reflects prudent use of debt financing. In our view, Adobe's balance sheet is extremely strong. The company has substantial financial flexibility to invest in growth, return capital to shareholders, or weather downturns. This is a fortress, not a constraint. Next up, profitability. Is this business actually making money efficiently? Return on invested capital stands at 25.69%, which is exceptional. This means that for every dollar of shareholder capital deployed, Adobe generates nearly 26 cents in annual profit. That is top decile performance in the software industry. Gross margin runs at 89.40%, a function of the high-margin nature of cloud-delivered software with minimal cost of goods sold. Operating margin is 36.65%, meaning more than one-third of every revenue dollar flows to operating profit before interest, taxes, and capital allocation decisions. Net margin sits at 29.48%, indicating that more than one-quarter of each revenue dollar reaches the bottom line. Free cash flow margin is 42.19%, which means the company converts an extraordinary proportion of revenue directly into unencumbered cash available for investment or shareholder returns. In the most recent quarter, these margins held firm at elevated levels, demonstrating the durability of Adobe's profit power. The company is not just profitable, it is a profit factory. The data suggests Adobe has built a business model where scale reinforces efficiency, and the combination of subscription economics, high switching costs, and dominant market position drives returns that would be the envy of most industrial or cyclical businesses. Onto growth. Is this business expanding, and at what rate? Over the trailing 3 years, Adobe's revenue has grown at 10.50% annually on average. Over the past 5 years, the growth rate accelerates to 15.20%. This is solid mid-teen growth for a company of Adobe's scale and maturity. In the most recent quarter, revenue grew 3.30% year-over-year, which represents a deceleration from the trailing 5-year pace. This moderation is something that bears scrutiny. It suggests near-term growth momentum has slowed, possibly due to market saturation in certain segments, competitive pressures, or macro headwinds affecting customer spending. Book value, or shareholders' equity per share, has declined at negative 2.60% annually over 3 years, reflecting share repurchase activity that reduces the equity base while maintaining or growing per-share earnings. This is an expected dynamic in mature, cash-generative businesses that return capital through buybacks rather than dividends. Adobe does not pay a dividend, choosing instead to reinvest and return capital via repurchases. The $25 billion repurchase authorization announced recently reinforces this commitment. The setup on growth is mixed. The 5-year trajectory is encouraging, but recent quarter deceleration warrants monitoring of management's ability to reignite expansion, particularly in cloud and marketing segments. Now let's talk smart money. What institutional capital is actually doing with this name? 20 top-tier investment gurus currently hold Adobe in their portfolios, signaling conviction from the best allocators in the world. Among the major institutional holders, William von Muefling at Cantillon Capital Management increased his position by 15.69%, representing 2.19% of his portfolio. Robert Alstein at Alstein Capital Management added significantly, increasing his stake by 56.25%, demonstrating recent conviction. However, Poland Capital Management reduced its position by 27.55%, suggesting some trimming of gains or portfolio rebalancing. Hillman Value Fund maintained its 2.01% allocation without change. Dodge and Cox funds added to their position by 35.83%. 11% of the 13F institutional filers tracked are net buyers, a figure below the 50% threshold that would indicate universally bullish institutional sentiment. This suggests mixed views among the broader institutional universe. Insider ownership is very low at 0.43%, meaning management holds virtually no shares relative to outstanding stock, a yellow flag in our view, as it suggests limited skin-in-the-game alignment with shareholders. Over the past 3 months, there have been 0 insider buys and 2 insider sales, another signal that company executives are not rushing to accumulate shares at current levels. The smart money picture is nuanced. Elite managers hold and some are buying, but insider activity and mixed institutional direction suggest caution. And finally, the verdict. Let's bring it all together. On valuation, the data suggests Adobe is attractively priced with a forward multiple of 10.65 times, a PEG ratio below 1, and a DCF margin of safety of over 60%. The setup looks interesting to us. Financial strength is excellent, fortress balance sheet, minimal bankruptcy risk, and substantial financial flexibility. Profitability is world-class, with return on invested capital near 26%, operating margins above 36%, and free cash flow margin exceeding 40%. This is a profit machine. Growth, however, warrants attention. 5-year expansion is solid at 15%, but the most recent quarter decelerated to 3.3% year-over-year, suggesting momentum has slowed. Smart money shows elite managers holding conviction, but insider activity is tepid, and institutional flows are mixed, cautioning against unbridled enthusiasm. The latest earnings beat on the bottom line, though revenue growth moderation bears watching. The earnings surprise on June 11th, 2026 will be a key catalyst to monitor management's trajectory. In our view, Adobe presents an interesting risk-reward setup for long-term investors. The valuation margin of safety is compelling, the business is supremely profitable, and the balance sheet is fortress-like. However, the recent growth deceleration and mixed smart money positioning suggest the stock warrants a disciplined approach rather than aggressive accumulation. We'd want to see evidence that management can reignite growth momentum before becoming maximally constructive. Everything in this video is our interpretation of publicly available data, not financial advice. Please consult a licensed financial advisor before making any investment decisions. That's the deep dive on Adobe Inc. Like and subscribe so we can keep providing you with no-nonsense, data-driven analysis of stocks. We will keep updating our videos as soon as new data that affects the stock becomes available.